Tonight, we're going to get into more of the meat and potatoes of tax prep. The big thing that everybody wants to know is what's taxable. And we're going to talk tonight about income, wages, interest, dividends, um, what you have to report, what's taxable, and what's not taxable. So these are big areas that everybody's concerned about. We're going to understand what interest, because you can have some interest that's taxable, some interest that's not taxable. Dividend income, and we're going to practice how these sessions, these forms of different income are reported on your 1040. And that's the big thing, is how are we reporting these on our tax returns. Wages, and this is considered earned income. Unearned income is interest income and dividends. Earned income is you go to a job, you get a wage. This is what a W-2 from 2024 look like. If you look at, I'm going to highlight some things here and point out some things for you. If we look over here at the wages, that's the amount of income that was earned. And then the employer is required to withhold federal income tax, Social Security tax, Medicare tax, and these are all the wages. And then this person lives in Ohio, so they would have a state income tax. The employer has a number. And all of these things are important because when you are electronically filing a return, you have to have the employer's state identification number, which is often different from the employer's. This is the employer's identification number, which is this number here. This is the employee, Abby Smith. This is her social security number. So you're going to have state wages. You're going to have income tax, local wages. If we're in Philadelphia, we pay local income tax, and then the locality name. And this is pretty much a W-2. So the W-2 reports are wages, the tips, if we get tips, bonuses, are all on this wage. And we're going to get a little more in depth with the W-2 because the W-2 also tells us more information. And again, here we're just looking at box one, and we'll talk about box one often. We talked about it the other week. Box one is the wages. Box two is what's been withheld federally. Box three is our Social Security wage. So our wages for Social Security, as on this example, are different than our wages for federal. So box one, three, and five are different. Three and five are the same. Social Security and Medicare wages are the same. But they're different from box one. As in our first example, all of the wages were the same. So box 12 is going to tell us what codes, and then 17 through 20 are state and local. And all of this information is needed when we prepare returns. So the employer information on that W-2 goes on the top of the return. We want the employee's Social Security number, the employer's EIN, which is their employer identification number. Every business, like every employee, will have an identification number. For an employee, we call it a Social Security number, or an ITIN if they're an immigrant. They'll have an ITIN, and the employer identification number is their EIN. We'll have an employer's name, address, zip code. Sometimes, if it's a large employer, they'll have control numbers, the number of their employee's name, and it has to match their Social Security card and the employee's address. All of this information, the employer is also given to the IRS and the Social Security. So if someone receives a W-2 or they work somewhere and they don't receive the W-2, the IRS still knows they worked and they received the money. And sometimes people say, well, I don't have to claim, I'm not going to claim this one W-2. The IRS already knows you have it. And with computers, they're very connected. We're not seeing any of that. And what you'll do is you'll get a letter from the IRS saying, hey, you didn't claim this money. And if you owe more money, you will owe interest and penalty if you don't file in a timely manner. I'm going to go over a bunch of these things, and it might feel repetitive, uh, but it's important. So again, we're back on our W-2, box one, wages, tips, other compensation. It could be a bonus. If you get a bonus, you get a bonus, and still going to take taxes out. It's going to just be in box one. Now, from that box, and the reason we saw one W-2 with a different amount than box um, three for the Social Security wage is because you would subtract any cafeteria plan deductions, any contributions to your IRAs, 401k, a 403b, retirement funds. All of the income from all the W-2s, if somebody had multiple jobs or their husband and wife, um, we would report all of the W-2 box one on Form 1040, line one. And we saw that in our example the previous week. Box two is how much has been withheld. And all of the box twos from all of the W-2s must match the 1040, line 25. So box three, your Social Security wages, your 401k deferments and IRAs and retirement plans don't reduce Social Security wages, the amount that's taxable Social Security. But Social Security caps. So if you're making $200,000, you are only taxed on $168,600 in 2024. In 2025, it's $172,200. Oftentimes people say this is a tax on the poor or the middle income because once your income is over 168,600, you no longer pay Social Security wage tax. So there's a limit. So once you make $168,601, that $1 is not taxed for Social Security wages. But so and Social Security is on box four is taxed exactly 6.2% of box three. So it's up to the wage limit of the 168,000. So you're only taxed at 6.2% for Social Security, and that goes in to pay Social Security for retirement. As you age or if you get disabled, you can collect Social Security disability. So that's what all that tax is used for. Medicare tax has no cap, and you do not get to reduce the amount of Medicare wages by the amount of retirement contributions. Medicare is withheld at 1.45% of the wage. And then above a threshold, you have an additional 0.9%. So these are money so your federal wages can differ from your Social Security and your Medicare. Social Security wages and Medicare wages usually are the same, but the Social Security wages have a limit on how much they're taxed. If you're working in a restaurant or somewhere where it's common to be receive tips, tips will be on a credit card receipt, or they'll be allocated by the to the employee by the employer. If you're in a restaurant where all the tips kind of go together and then everybody gets a piece of it, And they're going to be reported on the 4137. So you will report in box 8. The employer will say, hey, of all your credit cards, you had X amount of tip income. So box 9 is blank. It used to be for the earned income tax credit, but that has been disconnected on W-2s. So box 10, your employer, you can defer up to $5,000 per child for daycare expenses for a child, and I believe it's under the age of 13. So instead of getting taxed, you can have a dependent care plan with your employer up to $5,000 per child. That gets deferred, so your box 1 is going to be reduced by $5,000. Now you have to report on Form 2441, and we'll get into child care. If you have to pay child care up, at least of the $5,000, the amount you had deferred. If not, it becomes taxable. So on the Form 2441, we're proving, yes, our employer deferred $5,000 and put it into child care expenses, and yes, we did spend it on child care. And then box 11, it's non-qualified deferred compensation. It's taxable. It was included in box 1. And once you get into software of tax preparation, as long as you enter, and this is where data entry becomes so important, is you have to be careful, make sure all the data is entered correctly. So on box 12 is all codes. So if someone had a deferral of a 401k, elected deferral, if you receive health coverage, employer supplied health coverage, it's not taxable, but we're going to show it on your W-2. If the employer or if you defer money into your HSA contributions, that'll be at box 12, we'll have a W with a dollar amount that the employer put into your HSA, your health savings account. Code C is if you receive a large taxable group term life insurance. And there's limits to these, and we're not going to get into every limit, but what you'll see is a code C and the amount of term life insurance, and it's taxable. It is already included in box 1, but they're going to say what part of that box 1, and that's where you can reconcile box 1 if there's a question. Code B, AB is a Roth 401k contribution. The Roth 401k contribution does not reduce box 1, your income, but you can receive a savings credit. So we want to calculate that. And that's a Roth. And when that money's taken out of a Roth 401k in retirement, it is not taxable. When you take money out of your regular 401k, it is taxable because you're deferring it now. So basically, you're deferring income now to a later date. When you retire, most people, as they age, they slow down and their income is lower. So code 1A and B is qualified or ordinary dividends. If a business has dividends, you may receive them. And then if you're involved in a simple retirement plan, those are code E, G, and S, 403B, 457B, and a simple retirement. So when we look at all these codes, and this is in box 12 of that W-2. So when we look at different codes, DEG reduces taxable wages, shown in box 1 already. So they've already reduced the wages. You don't have to reduce them again. But the employer just saying, hey, this is what we put in this is why we reduced box 1. So B, AA, BBEE is a Roth contribution. It's for reporting only. It has no effect on the tax return. DD, no effect. W, this is going to go in Form 8889, and this is your HSA. So when an employer contributes to your HSA, that report goes in Form 8889. And again, that is, the employer contribute to your HSA. Now in that Form 8889, it's going to ask us how much of that money, if the employer contribute $5,000 to your HSA, how much of that did you actually use for health expenses? And if you didn't use it for health expenses, then it becomes taxable. So C adds to taxable income, and that should already have been included in box 1. Basically, we're getting information. And L is no effect, it's a reimbursement, it's only administrative. And then if the T is a credit calculation, 8839. So you don't always have to remember all of this. And especially as we use software, it'll trigger, if we have a W, it'll trigger, hey, you had a HSA contribution. Okay, so box 13, we have the income reported on Schedule C, not A, as a statutory employee. So sometimes, oftentimes a minister, there's certain kind of professions, they'll be considered a statutory employer. The income is then reported on the Schedule C, not on A, and not on the 1040. And the employer did not withhold self-employment tax. So we have to go back and calculate self-employment tax. So box 13 also, you're going to check are you involved in an IRA deductions or a retirement plan? So if you're involved with a retirement plan with your employer, you cannot take other IRA deductions. You can take a Roth depending on income limitations. But so it'll say, hey, involved in a retirement plan, because a lot of times people will say, hey, I want to donate another, or not donate, I want to contribute another $7,500 to my IRA account, but they're already involved in one in their employer, they cannot double dip that deduction. And 90% of the time, it's always better to take the retirement with the employer. Oftentimes, employers will match that retirement. Third party sick pay. This is when you have an insurance, you're out on disability, an insurance company will pay your wages. You may have an insurance policy that pays disability or sick leave. And usually it's up to 60 to 80% of your normal salary. But it is taxable because it's technically wages. So box 14, you're going to see things like union dues, and union dues we can deduct certain places. In Pennsylvania, we can deduct them on the Pennsylvania return. Uniform allowance, not, taxable. We'll see state disability, insurance, educational assistance, paid time off. If the employer can give you paid transit or parking benefits. So they're not always needed for the federal return, but we're going to use them like union dues. We would use them on the state return. So we saw box 15, 16, and 17 were about our Pennsylvania. I'm going to talk Pennsylvania, but for our purposes, we're going to get people in Pennsylvania, New Jersey, New York, and Delaware are our primary people that we do tax returns for. So we have to look in their state wages. What state? Sometimes if you work in a state, the state you work in your employer will withhold taxes in that state, although you live in Pennsylvania. So we will often see someone who works in New Jersey, they withhold New Jersey taxes, but they live in Pennsylvania. In that case, you have to file both a Pennsylvania return and a New Jersey return. So you have to file two tax returns. And then they kind of want to wash the other. But if they withheld taxes in New Jersey, you have to file the return and ask New Jersey, hey, give me a refund. I'm also being taxed in Pennsylvania. But you have to pay Pennsylvania because you haven't paid any taxes in to the state you live in. If a taxpayer is filing their taxes late, sometimes they'll complain because, hey, I'm getting a refund from New Jersey, but I haven't gotten it. But I owe my taxes by April 15th. So if you owe Pennsylvania, you owe them April 15th. But if you haven't received your New Jersey refund, you still owe Pennsylvania by April 15th. So box 17 will tell us what state income tax was withheld. So they'll tell us what state it's in. They'll give us a state employer ID number. And again, your state wages will differ at times from your federal wages because what could be taxable to the state may not be taxable federally and vice versa. And most of us here are in Philadelphia, but we do have local governments right outside of Philadelphia. Philadelphia does have a local tax. So if you work in Philadelphia or you live in Philadelphia, you pay a Philadelphia wage tax. So even if you live in New Jersey, but you work in Philadelphia, you have to pay the wage tax. And it's a little bit different rates for a local person versus somebody who lives out of Philadelphia. If you work in Montgomery County, the different counties will have their own taxes. So we want to be careful of this. You'll see the locality name, if it's Philadelphia, just have PHILA or PL, or the Philadelphia code is 51500. You may sometimes see that in the locality name. So again, we want to know, why don't the boxes match? So box 1 is less than 3 and 5. That's because of usually because of retirement plans. Box 3 is capped. Social Security limits, Social Security wage limits have been reached. So if box 5 is greater than 1, it's some pre-taxed items apply to the federal, but not to Medicare. And then box 12 gives us the reason why these boxes. It'll tell us, hey, they have a deferred child care, they have deferred retirement, they have an HSA. So box 12, all those codes will tell us why. So this is a W-2 can be pretty intense. So this is our W-2 again. And if you look at it, you're going to have the employee's social security number, the employer's identification number, their EIN, the employer's name, here's ABC Rental Inc., their address, the employee's name, John Q. Taxpayer, his address, there's a control number. Some W-2s don't have control numbers, some do. It's actually the business whoever owns the business, their control number for that employee. It doesn't matter. We don't do anything with control number on the tax return. So box 1, we have wages 42,500. They withheld 4,250. And now the wages for Social Security and for Medicare are 45,000. And again, we're going to look at the 42 versus the 45. We go down into our codes in our box 12, and we have different things that, the codes that do affect and don't affect box 1 and box 5. So box 13 tells us that, yeah, they're involved in a retirement plan, which then tells the IRS if somebody tries to take the adjustment to income by reducing their income by retirement contributions, they can't do it. Because they've already been adjusted here on our W-2. Because their wages were actually 45,000, but they put money into a retirement plan. So we have Pennsylvania ID. Again, you need that. State wages, and then local wages. And those are usually pretty much the same. We have locality of Philadelphia. So that's pretty much our W-2. Do you have any questions?
Cuando una persona trabaja independientemente, es obligatoriamente tiene que pagar seguridad social y aportar al plan de jubilación.
When a person works independently, he must pay Social Security and contribute to the retirement plan.
So is right. So your Social Security is retirement that the government gives. You can opt with your employer whether you're going to contribute to the employer's retirement plan or not.
Sí, entonces no es obligatorio que ellos aporten al plan de jubilación.
The element is not mandatory for them to contribute to the retirement plan.
Right. So as your employer's retirement plan is optional. The Social Security tax that is the government retirement plan is not optional. Everybody has to pay into that. So if you work anywhere, you're going to pay into Social Security and Medicare tax. Medicare is the insurance, health insurance for seniors, and then Social Security is the Social Security you can start withdrawing when you reach the age of 62. It's very minimum. Like right now, I think it's about if people are 60, 62 right now, they're only withdrawing maybe $1,000 or under a month. But and as you wait and you work, the longer you work, the higher that amount will get. So you can, if you wait till you're 65, it'll probably be like 1,200. You wait till, and that's why a lot of times people wait till they're in their 70s if they don't need, if they're still working, they don't need Social Security. If they wait, the amount they get each month will increase. Social Security does cover if you become disabled, and it will just cover your child. It's disability income. So retirement money that your employer defers from your income is optional. Sometimes employers will just put money in your retirement as a benefit. But if you defer money, if you wanted to contribute yourself, you contribute to your employer. That's an optional, but Social Security is not an option. So those are your W-2. These are, and your W-2, 1099 INTs, all of these things are what we consider source documents. So when you first start doing tax returns, that's going to be your first job is to do data entry. So you're going to enter these documents into the software. And that's why I'm kind of going over everything just so you know to look in every box. There's not a lot of taxpayers who have dependent care. And oftentimes that's overlooked, but we have to really make sure that we look at box 10, make sure we account for that dependent care. So we're going to talk about next is 1099 INT, and it's interest. So it's interest income that you receive from a bank, your credit union, a broker account, and you only have to, you only will receive a 1099 INT if you receive more than $10 of interest. If you receive $8, you're still required to report it, but they're not going to issue you a 1099 INT. So when we look here on our return, and if you look here Try to get a thing, but you want to look here. This is the TAP 1040, line 2A. We were just talking about line 1 for our wages, 1A. But now we're going to talk about line 2A, and that is tax exempt interest. 2B is our taxable interest. So we can have tax exempt and taxable. We're going to go through what the difference of these interests are. So this is a 1099 INT. You'll see the payer has a TIN. The payer is Sterling Heights, Michael. Technically, if you loan someone money and you collect interest, that's interest income. And this should be reported if you receive more than $10 of interest income. So we've prepared these for clients who maybe have lent a family member money and charged them an interest rate. And they make more than $10, they would have to claim this interest income. So again, we have the payer's TIN number, their taxpayer identification number, and the recipients. So Michael received it, and West Life Insurance paid Michael interest. He received interest in the amount of $1,200 in box 1. Box 2, early withdrawal penalty. And we're going to go through each of these as well. Box 3 is U.S. savings bonds, treasury obligations. And then box 4 is if they withhold taxes from the income. So they can federally, if you're only receiving a couple $100, $62 for interest from your bank, from your checking account, they're not going to withhold taxes. If there's expenses associated with these, they'll be marked down here. If you're involved in a foreign bank account or a foreign investment, you may receive foreign tax paid. Now that foreign tax paid, you can get a tax credit under the United States tax. So if you're paying tax in another country, you can get credit in the United States when you file your federal return. But they're going to want you to fill out box 7, which we didn't have filled out here. What country was that paid in? Tax exempt interest. There's certain investments that you can invest in that are tax exempt. And then there's specified private activity bonds. And they're a bond that you buy, savings bonds or government bonds, but you can buy bonds for a company that's borrowing money, and you can buy a bond. Each bond usually sells for $1,000, $5,000, or $10,000, and then you get interest on it. And you can pay a premium for a bond. And the good thing about this is that you don't have to understand bonds and premiums and all of that. And I can go in and explain it all to you, which would take us quite a bit of time. But a bond premium is you're paying a premium on a financial instrument on a bond because the interest rate's high. So if our current interest rate is 4%, but there's a bond out there that's worth 6%, that's the interest on that bond. When they issued it, you might pay a premium or a market discount. If the current interest is 4%, but the bond interest is only 2%, you may get a credit. So that's what all of these numbers do. And for our purposes, we're just entering this data. We have to know where to take this data and how to put it on our tax return. So if your interest is over $1,500, or you have self-financed loans, foreign accounts, or again, if you've self-financed or you're seller finance, you sell a house and you hold the note, you hold the mortgage, you have to report them. And this is where we're going to report our interest in ordinary dividends. But we're just talking about interest And this is your Schedule B. This form will get attached to your 1040. So if your total interest is more than $1,500, you have to fill out a Schedule B. If you receive $57 from interest on a bank account, you put that on your 1040. You don't have to fill out a Schedule B. So most treasury bills and notes are taxable to the federal and often not taxable to the state. Early penalty, we saw that early penalty in box 2 for early withdrawal. If you have a CD, you have a 6-month CD, but all of a sudden you need your money in 4 months, they'll charge you a penalty. And we can deduct this. This is an adjustment to income. If you look at line 8 here, it's penalty on early withdrawal of savings. So we can deduct it from our income, even though we were charged it by the bank. And this is what we call Schedule 1. So you'll see a lot on the 1040. If you read each line, they'll say schedule this, schedule that. And these are how your 1040 is basically the index of your tax return. Is like an index of a book. It tells you it's the reporting of the final numbers, but each line could have multiple forms behind it. So if you have adjustments, if you early withdraw from your savings account CD, you would report that here. So box 3 of our 1099 INT is interest on savings and treasury bonds. Unfortunately, they don't give us out these Series EE coupons. When I was in grade school and I had grandparents buy me Series EE. So a Series EE bond, you can buy them now, but it's all electronic. But they actually are tax-free if you use the income, the interest from it to go to college or for higher education. So they're normally taxable except if you use them for education, Series EEs. I bonds, treasury bonds, all of those things will be reported in box 3. Most of them are not taxable. But again, you're going to report this on line 2B of the 1040, which we saw before. But a Series EE bond, if you have a $5,000 bond, which this is, you can buy them for $2,500. But oftentimes you have a $50 bond, or I would buy my nieces and nephews $50 bonds. So the $50 bond only cost me $25. And it matured in usually about 5 years to 7 years. And then when it matured, it was worth the 50, but I only paid 25 for it. And as kids, we like to get that. We hold them, and then we can take the bond to the bank, and we get our money. Now again, it's all electronic. So here's what's taxable to Pennsylvania, not taxable to Pennsylvania. So treasury notes, treasury bills, not taxable in Pennsylvania. Savings bonds, Series I savings bond, the I bonds, which are part of government bonds, is exempt too from Pennsylvania. So most interest from government obligations is tax-free. Those are any government bonds, Series EE. Taxable interest is from your bank accounts, CDs, if you own corporate bonds, municipal bonds. So if I own a bond from New Jersey, it's going to be taxable in Pennsylvania. So a lot of times you'll hear about what they call triple tax-free. You can get a bond, and if they're going to build a new bridge, they'll release bonds to raise money. So the locality, if New Jersey's going to build a bridge, they'll raise, and I buy a bond that's going to pay me 7% interest. The 7% interest from New Jersey is going to be taxable in the federal and the state level, and Philadelphia. But if I buy a bond that is triple tax free, it's not taxable to the federal. And oftentimes the educational bonds, if there's a bond issued for a school, a lot of times they'll be tax free to the IR, to the federal, to the state, and to the city. So you can look at different bonds when you're investing. But if you're in Pennsylvania and you buy a municipal bond in New Jersey or Delaware, it's going to be taxable. Non-US government bonds are taxable in Pennsylvania, and private activities bonds are taxable. If they're taxable federally, they're taxable to the state. So the good thing again about the 1099 INTs is they're going to tell us. But we may have to know the Pennsylvania taxable income. So example here is a taxpayer earns $135 from their savings account, $220 interest from an I bond, $90 treasury note. So federally, the savings account is taxable, the I bonds and treasury are taxable. So everything federally is taxable. But in Pennsylvania, only the $135 of interest is taxable. The other $310, the $220 I bond, and the $90 treasury note are tax free. So you save on these incomes, you can save $135 of taxable income. And if you think about people who invest larger amount of money or have larger amount of savings, and this is why you don't want to keep your large savings in a savings account. You want to invest them. So you're getting one, you can either invest them to get more income at a higher rate, or you can invest them in tax-free vehicles. So on your 1099, you'll have a federal box withheld. We talked about that. And again, that's going to be reported with all the other federal tax you have withheld on your W-2. Rarely, investment expenses are not deductible after the 2018. It was a 2018 TCJA event. So every couple of years we have new tax laws come out. 2018 they changed that you cannot deduct investment expenses. Foreign tax paid in box 6. And that's gonna so when you pay a foreign tax, you can either deduct it as a itemized deduction on your Schedule A or as a tax credit. So we can play with that. We can do what we want with that. So box 7 tells us what country or U.S. possession that income was earned. So box 8 is our tax exempt interest. So this is exempt from the federal government. So like we spoke, municipal bonds, mutual funds, some state and local are not taxable to the IRS. But they still have to be reported, like we showed you on our Form 1040 on line 2A, the tax-free and then the taxable. Now, when we go in to calculate some credits for how much of our Social Security is taxable, how much child credits we get, we will use an AGI calculation. Now, when we figure AGI for these credits, we're going to include that tax-free interest. So it's tax-free, but if you're looking at other credits, you have to calculate that back into your AGI. So private activity municipal bonds are for the most part tax exempt. But if you have a high income earner, they're going to be subject to the ultimate minimum tax. And once you get into that, you know, an ultimate minimum tax, there's a whole, once your income is above a certain levels. So again, we talked about the market discount. When a bond is sold below and purchased below face value. And that means if you have a $5,000 bond and you buy it for 2,000, your bond market discount was $3,000. When that bond matures, you're going to get $5,000, but you purchased it at a discount. Same, and usually it's not that much money. When you get a market discount, usually it's $25 or $30. It just depends again on interest rate and what the market's doing. Bond premium means you're paying a premium for a higher interest bond. So it's going to, so if the bond is a $5,000 bond, but you pay $6,000 because the interest rate's 10%, and you know you're going to make that up over the life of the bond, you're going to pay a premium because you want that higher interest rate. So bond premiums on tax exempt bonds, it reduces the tax interest income. Now, again, if you receive over $1,500 of interest and the bond premium on the tax exempt bonds is all reported as ordinary income, Schedule B. So all of these things will flow over to our Schedule B where we talked about our interest. So again, here's just a little summary table. I think that's really good for interest. Box 1 is taxable interest, 1040 line 2B. If it's over $1,500, we have to put it on a Schedule B. Early penalty, withdrawal penalty, it's an adjustment to income. It goes on that Schedule 1. U.S. Treasury interest, 1042B, it's taxable. But to the Pennsylvania, we're going to subtract that. That's not going to be included in our income. Federal tax withheld is going to go on the 1040 line 25B. It's part of our tax withheld. We already paid tax in, or we had tax paid withheld on that income, especially if you have larger income of interest income. You want to have some tax withheld because you don't want to be hit at the year end with a large tax bill. And if it's too large of a tax bill, you're going to pay interest and penalty on that tax due. So box 8 box 6 is our foreign tax paid. And there's a foreign tax credit, or you can have a deduction on your Schedule A. So foreign tax, we have two ways to deal with it. Majority of the times people will put it on a 1116, which is a foreign tax credit. Box 8 is our tax exempt interest. We're still going to report this on line 2A on that 1040. They still want to know, and that tax exempt interest still gets included in our AGI when we're figuring other credits. So private activity bond interest, ultimate minimum tax rules applied, and then the adjustments will go on our Schedule B. And if they have withheld any state taxes from the interest income, that'll go on our state return. So dividend income is reported on a 1099 DIV. So our interest is on a 1099 INT, dividend income 1099 DIV. So this reports dividends and distributions from investments, stocks, mutual funds, ETFs. If you receive over $10 in dividends, you'll receive a 1099 dividend. And there's all kinds of different ways, investment companies, E-Trade, Charles Schwab, all report differently, but you'll see them on a brokerage package where you'll get the 1099 dividends. If somebody buys and sells stock, you'll receive those. We're going to talk about that in capital gains. We'll get to capital gains, but right now we're just talking about the part of the 1099 is dividends. So here's a dividend. Again, Chemical Mutual, you'll have People invest in Pico stock and smaller stock companies, Comcast. And normally this 1099 dividend is filled in everywhere. Everything is filled in. You're not going to see this for the most part. The most thing you're going to see is box 1A, 1B, and 2A. So box 1A, and I'm going to focus on those because a lot of the other ones can get convoluted. Um, so 1A is ordinary dividends, and then 1B is qualified dividends. So when we go over to our 1040, so this is the 1040, and if you see, we talked about 2A, we talked about the tax exempt interest and taxable interest. Next line, 3A, is our qualified dividends and our ordinary. So qualified dividends are not taxable, but ordinary dividends are taxable. So this is where we're going to put our dividend income. Now again, and you can see to the left, it says attach Schedule B if required. So at the bottom half of that Schedule B that we shown you before was for dividend income. So we're going to put here that all their dividends received, including both qualified and non-qualified. So qualified dividends, box 1 is taxed at a lower long-term capital gains rate. So there is a capital gains rate that is less than the normal income rate. So box 1, our qualified dividends, is taxed at a less amount. You have to meet a holding period. Usually it's 1 year. So those qualified dividends will be reported on line 3A on your 1040. Now, the investment company will tell you exactly what are you don't have to figure it out. You will get the receipt of a 1099 dividend, a source document is a 1099 DIV, and that'll tell you exactly what is qualified dividends. And then on there, you're going to have on line 2A a total capital gain distribution. If you have that, you're going to report that here, and this might be hard for you to see, but line 13. And I can also send you, if you want the PowerPoint, these slides, if you want a copy of them as well. If you want to read those. And so the capital gain losses and profit from your buy and sell stocks inside your stock investment, they buy and sell stock. So they may have capital gains. And it's always taxed as long-term capital gains, and that's why we're going to put it on line 13, which says capital gains distributions. Okay, and that's going to be that's reported there on your Schedule D. So I'm not going to go through a lot of these. These are like special gains. I want you to be aware of them. Seldom have I ever seen them in 38 years, unless someone's involved in some kind of very specific type of investment. As you learn taxes every year, even myself, every year, I'm going to learn something different. So it's very much a field that you never feel like you know it all. There's always something new to learn. And every year the laws change, so we learn something new. So non-dividend distribution is a return of capital. So if you buy into an investment, they may give you your investment back. And so that's not tax, because that's an investment. You already paid tax on that money when you bought it. So you've heard the tax withheld. If you have tax withheld from a dividend, they're going to withhold 24%. And then again, it's going to be on line 25. is federal income tax withheld. We're going to have income tax withheld from our W-2s on 25A. And then on 25B is we're going to have the tax withheld from our interest and from other 1099s are going to be, 1099 divs, any other 1099s is on 25B for taxes withheld. Not all investment companies are withholding taxes. It all depends. But when you receive that source document, it will tell you. And that's where you have to look at every box and check it, make sure there's a number in there or not. Sometimes as you get used to it and you're going along, sometimes you forget to check every box. One of the things we do in our office is we make sure that whoever does the return, someone else checks the return. So we have a double checking system. So we take every source document, the person who enters it, then someone else will check the return to make sure it's been entered right. It's just easy to miss that, and sometimes just having a second set of eyes on these source documents to make sure you didn't miss anything is good. Even for myself, I still have somebody check my returns. So foreign tax information, again, like we said with foreign interest, you again are reporting your foreign tax paid and a country where it was paid, and it's usually reported on the 116 for a foreign tax credit, or you can itemize it on your Schedule A. Liquidation, sometimes investment goes belly up and maybe they liquidate, they go bankrupt. There's a non-cash liquidation, they give you a piece of equipment. I've never seen a non-cash liquid distribution reported on a 1099 dividend, but it's possible. And a lot of times for those kinds of more complicated returns, they'll actually be on smaller corporations. So a smaller corporation who maybe has only 4 or 5 owners still has to give each of the owners or each of the investors a 1099 dividend if they paid out a dividend. So your tax exempt interest dividends. So you can have a company that invests in mutual bonds and gets interest in the company. And again, this is going to be reported on your 1040. Now, this is going to go up on line 2A and not on 3 because this, and again, it still affects your AGI basis calculations. So private bond interest, private activity bond is exempt but subject to ultimate minimum tax. And ultimate minimum tax we'll get into very briefly later in the month, probably or next month. And then box 13 to 15 is just a state name, state identification number. So all the forms, the source documents, W-2s, 1099s, are going to have the payer's federal information, the payer's address, the payer's state information. It's going to have the recipient's information, social security number, address. So these are things that you always want to look for. Did they withhold any state tax? So that's pretty much what we're learning today. And that was a lot. We got through it quickly. But they're source documents. And so this is our homework. And this is I'm gonna also I'm gonna email you the homework separate as well as so what you're gonna do with this homework, and this is where you get to practice. So this bumblebee lives alone in San Antonio, Texas, and has never been married. So what is his filing status?
Single?
Correct. He lives alone, never married. He's single. Lives alone, no children. Single. Okay. So I helped you out here with your homework. So and that's where you want to list look at stuff or when a client comes in. Bumblebee lives alone in San Antonio, never been married. He's employed full time as a store clerk at the Honey Shop. He's a U.S. citizen, lived in the U.S. the entire year. He's not the qualifying child or dependent of anyone else. He provides you with, because everybody has to provide you with a copy, photo ID, driver's license, some kind of passport, some kind of photo ID. Excuse me. It cannot be expired. So if it's expired, we have to say, hey, get another ID. So during 2024, Bumble was employed full time at the Honey Shop. He received his W-2 from his employer, which I'm going to show you next slide. And he also received interest and dividend income statements attached. He had no interest in or authority over any foreign accounts. He also did not receive, sell, exchange, or otherwise acquire any financial interest in virtual currency, Bitcoin. He's not invested in any of those. So these are his, what we're going to call his source documents. So you're going to take this. So here, the first part is his information, his address, his email address, his occupation. And then here's his W-2 income. His wages, box 1 is 50,000. Federal amount withheld 5. Social Security wages are 50. So Social Security tax withheld. Medicare tax withheld. And his Medicare wages in the Medicare. So we can tell that he's not in a retirement plan. Because if he was in a retirement plan, he has no deferred compensation. And then his interest from Queen Bee Securities was $2,500. And he received dividends from Hive Bank, 800 ordinary and 600 qualified. So the thing is that when you do this homework, you want to maybe go back, and I'll upload the slides tonight, but the recording probably not till tomorrow. It takes a while for the recording to go through. And you'll have the recording to go through it. I'm going to send it to you and Jesse together tomorrow. But you'll go back through and listen and look at the slides from what we looked at for W-2 income. Where do you put that on that 1040? So what I want you to do is you're going to need a 1040. You're going to need a Schedule B. So you're going to go to the irs.gov and you're going to get your forms. And once you get your tax forms, then you're going to fill them out. So, and that's going to be your final exam. This is very much like your final, is you're going to get information like this. And you have to fill out the 1040.